shocking video for the Federal Reserve markets and how things are really building up on each other. Quick note though, I'm extending the coupon code one day, today only. We're going to end it tonight because I couldn't get back to all the bundle coupon requests at staff@meetkevin.com. Send us an email there if you'd like a bundle. Otherwise, check out meetkevin.com. And we've got a coupon code expiring tonight. Prices will be going up tomorrow morning, and I'll show you exactly how to build your wealth from zero to millionaire in real estate investing. That's how I did it. Give you the exact blueprint for how to do that. A lot of people getting into that because they see an opportunity coming up in real estate, stocks and psychology of money, and of course, how to make more money with entrepreneurship or employment, either direction, featuring artificial intelligence. So check those courses out. A link down below. The price will be going up substantially tomorrow as we have a major price increase planned. So use that coupon code before it expires tonight. Or email us at staff@meetkevin.com. Well, you won't believe what year Mike Wilson, one of the biggest Wall Street bears turned bull, has to say about this latest stock market rally that we're in and what year he compares it to. We've got to talk about that, but we've also got to talk about big catalysts coming up. I'm also feeling a little bit better, which is great, and I want to start with a note of psychology, because in the programs in Building Your Wealth, we regularly talk about psychology. For example, in this morning's course member live stream, when we're looking at consumer discretionaries, we're regularly analyzing, where could the next play be? But for psychology of today's market, I think one of the best ways to think of how does, a company like Nikola go from 50 cents to $2.50? Maybe it's a good thing, maybe it's fundamental, maybe it's a short squeeze, maybe it's a combination of both. And how do some of these smaller companies start taking off, sometimes even at a greater or faster clip than companies with really strong fundamentals? Like, how does a Carvana burn its bondholders and go from near bankruptcy at a few dollars per share to over $40 per share, 10xing? Well, one of the ways that I like to think about this is stock market Jenga. Think about this. 2022 starts and you kind of have pulled quite a few pieces out. The tower's starting to wobble a little bit, and then come about the summer of 2022, this thing's really starting to shake, pieces are falling off the top, and by December you have a complete Jenga collapse. Well, in order for you to rebuild the stock market, you can't only have your favorite stocks go up. The stock market Jenga doesn't work that way. Instead, you need pretty much everything to go up, even the crappy companies. And the reason it works that way is the more expensive the really good companies become, the more people move across what they call the risk curve, and they start allocating to some of these other smaller names, and those can induce short squeezes. In fact, we'll probably make a video on some potentially high short interest companies, especially since a lot of you have been asking for those. But before we do that, it's worth considering, okay, in that case, even in a strongly built Jenga tower, if you remove a piece, in other words, one company like Yellow Trucking goes bankrupt, doesn't actually mean you're going to knock over the tower. The tower falls when it starts wobbling and you've had a lot of companies collapse. That's when the tower falls. Not necessarily collapse either, but when market fear at least sets up such an element that, we think everyone's going to collapse, much like what we had in 2022. This thought that we're going to get Paul Volckered, inflation will never be transitory, this is entrenched, we're back at the 1970s, oh my gosh, we're all screwed. That ended up not being the case, although that doesn't stop other YouTubers today from constantly making videos about how every banking collapse is basically the end of you. But, oh well, I guess they can sit out the stock market and miss out. So, what does Morgan Stanley's Mike Wilson suggest? At least what year does he compare us to? Well, it's none other than 2019. Take a look at this. Morgan Stanley's Mike Wilson is now suggesting we are in a 2019 style rally, which is a rally that's backed by basically policy, whether it's the Federal Reserve pausing their rate hikes at the end of 2018, basically going back to QE, which is kind of what we saw in 2019. And Mike Wilson is now suggesting, hey, we've got some eerie similarities today. Just by looking at some retracements here, it's been a little more aggressive now. He's got about a 28% increase over here, whereas we're at about a 36% over here. But he actually suggests that this kind of rally can keep going. And I find this very fascinating because one of the things that I mentioned at the start of 2022 was that the stock market likes thinking ahead. The stock market historically has pivoted in times when the Federal Reserve has had its emergency U-turn, right? We've talked about this analogy before where we talk about how the Fed pivoted in February of 2009 or March of 2003. Then we have December of 2018, and then of course March of 2020. These were some pretty dramatic pivots from the Federal Reserve. And we've previously shown that when the Federal Reserve takes these emergency U-turns that it did during these dates to bail out the market, it's historically a really good time to invest in stocks. And we made this comparison to this cycle and said that, well, look, as soon as inflation starts coming down, it's probably going to happen gradually, and then we'll get a heads up that, okay, well, if inflation keeps going that way, then the Federal Reserve will pause and we'll get a U-turn from the Federal Reserve. But it won't be as dramatic potentially as one of these time frames because inflation will probably gradually come down. So the stock market could slowly price this in the form of a Nike swoosh recovery. That's the foundation of how I came up with the Nike swoosh thesis back at the end of last year. It was that if inflation gradually comes down, the stock market will gradually wake up to realizing that, oh wow, maybe inflation will end up proving to be transitory. Now, a lot of people get offended when I say that. They're like, Kevin, how could you say that? Have you been to a grocery store lately? We understand that inflation has raised prices for a lot of things. But we also realize that the rate of growth for those things has slowed dramatically. In fact, in the last inflation reports, it's gone negative for food. So we've started to actually see not just disinflation, but deflation for a lot of food items that have run up so expensively. Now, that doesn't mean they're less expensive than they used to be. They're still more expensive. But from a market point of view, this is fantastic. So what else does Mike Wilson suggest? Well, there's some cool things here. Take a look at this. So Mike Wilson, he mentions that the next sectors that could be interesting to pay attention to are utilities, energy, and financials. I don't profess to be a utilities buff, so I want to look at the others. Energy, I think, is right now, at least you could look at it as oil or renewable energy. I'm not much of an oil bull, although if we have a recovering economy, oil could do well unless production increases at a similar clip. In that case, you're just speculating on a commodity. With China moving pretty slowly and hopes that China is going to stimulate more, but so far, ideas that no, China won't stimulate more because that could take away some of their party power as it empowers corporations in China more, which is something that China is apparently worried about. This was a Goldman Sachs piece we addressed the other week. I'm kind of injecting this as well. Anyway, I don't really want to bet on oil, so I'd rather look at potentially cheap renewables, which just got a lot cheaper thanks to Enphase, but that could still be in a trough right now, right? We have not seen euphoria in energy in the solar sector, at least, right? So keep that in the back of your mind. But what are two others potentially? Well, financials. Look at what SoFi did this morning. SoFi absolutely exploded. Why did SoFi explode? SoFi exploded because of a higher projected net income in the next quarter and for the fiscal year. Now that's interesting because they're doing a lot more personal loans. They're doing personal loans at like 14.5%. And I'll tell you, there's actually a lot of appetite for those kinds of loans. This is why we saw a PayPal be able to sell off its buy now, pay later portfolio to KKR in Europe, because there's a massive demand for higher yields. And if the economy's not going to go into a recession, then those higher yield loans could be less risky. Hear me out on that for a moment. If somebody goes to you and says, hey, I'll pay you 5% on a government secured treasury bond that has no risk of default, then you're kind of like, okay, cool. So my risk-free rate is 5% or 4%, whatever it is. Then you compare that to, okay, well, what if I want more yield? Well, then you have to take on risk. Okay, so how about you take a whole buy now, pay later portfolio that's yielding like 15% and you slice it up. And you're like, okay, I just want a slice of that, which gives me a slice of 1,000 different people's Peloton bikes or whatever, right? Even if 10% of them default, you don't really care because you have a slice of everyone. You're not just having one person's default. So you're somewhat secured because then a 15% return's like 13.5% of 10% default. Big deal. That's still way better than 5%, right? So you have pension funds, institutions, and a lot of money managers who are like, let's buy up some of these riskier loans. So what does SoFi get to do? Well, I don't know if SoFi does this. I could read a little bit more into it, and I probably will. But my suspicion is that SoFi is basically refinancing people's credit card loans from like 23% down to 15%. And then they're able to take those loans and sell those loans to these money managers. And SoFi is taking basically a fee in between. Now, a lot of people are going to have heart palpitations when they say that because they're like, what? SoFi doesn't take fees? No, they're not taking fees from the consumer, but they take fees when they sell the loan. This is very normal. I'm not going to go into institutional money management. It's just the way you discount the loan or the way you sell the loan off, what interest rate you sell the loan off for. All of that is built in. They make their money. Point is, they're making more of that money because there's more appetite probably for those loans right now because the market's going, maybe we're not going into a recession, which is actually probably really good for a company like PayPal, Affirm, or SoFi. So financials, I actually agree with Mike Wilson on financials could be a fantastic place to be right now. I don't know. I've been saying for a while, I don't want to own financials going into a recession. But now that it looks like we might not be going into a recession, and you're looking at, sure, yellow trucking laying off 30,000 people, but is that really going to affect non-farm payrolls coming out this Friday? Well, I don't know. Let's see. This survey says 200,000 jobs expected for the non-farm payrolls. ADP is expected to come in at 188,000 in 2 days on Wednesday. So you got ADP on Wednesday. You've got jobs on Friday. So if you're looking to see what happens with jobs, pay attention to those dates. Or look at the JOLTS numbers coming out tomorrow. We're looking for 9.6 million. For job openings. What you really want is a little bit of a lower JOLTS number. Not too low. You still want job openings, so those yellow trucking people who just lost their jobs can get a new job. Although UPS doesn't have a lot of job openings right now. We looked. So JOLTS, you want that to come in slightly low, and then you want jobs to come in probably at estimate. You don't want it to be too hot, although even if it does come in hot, it's okay. You don't want it to come in low. Really low on jobs would be bad, because now you're knocking on that recessionary door again, and financials will get punished again. So solar and financials, interesting space. Mike Wilson does suggest there is another space that is fascinating right now, and that other space is potentially consumer discretionaries. However, he also suggests that those consumer discretionaries could be at most risk, although consumers are showing signs of optimism. So I wrote over here, for the consumer, I was thinking, well, that's also good for financials like SoFi and Affirm, but it's also potentially good for a Disney, an Etsy, and then I wrote Palantir just because I wanted to mention Palantir's killing it. Remember, they got a crazy robust balance sheet, and a lot of people see them as like one of the strongest potential AI plays for software. Although Bloomberg Intelligence doesn't think so. Bloomberg Intelligence just did a piece on them. I was just looking at them this morning, and Bloomberg Intelligence did a piece on them and said that their commercial segment remains pressured, mostly because companies are being a little bit slow to renew some of these contracts. Didn't stop them in their last earnings from rallying, though. They went from like 7 to 11 in their last earnings, and now they're like 19. It's crazy. Really, really impressive. So anyway, there are a few things to really think about here. Of course, we got inflation data coming out, which I'll talk about in just a moment. But think about this for a moment. In this world that we're in of stock market Jenga, hopefully you use that coupon code link down below. By the way, great news coming on House Hack. Knock on wood. I don't want to reveal everything yet, but a certain 3-letter organization seems to be very happy. So I'm happy. Anyway, we'll leave that there. Then we're going to talk about the CPI data and projections for that in just a moment, which is on Lauren's birthday. But what I really want to hit on is this Jenga analogy. And the Jenga analogy says, first of all, from a psychological point of view, you should not be discouraged if not all of your stocks are green all of the freaking time. I know there are a lot of people who are like, dude, Kevin, how is SoFi up 20% or whatever, and Tesla's only up 0.4%? And go, stock market Jenga. It's totally okay. It's totally okay for markets to spread their gains. In fact, a broadening rally will support the growth of plays with really, really strong fundamentals. And I will say, SoFi's fundamentals actually look better when you get away from a recession. In fact, all financials basically look better when you get away from a recession. So this broadening rally is very, very good. So just because your stocks aren't up every single day, that is okay. It's okay to see the other players win, because the more the other players win, the more you can win. I know there are a lot of people that are like, but I mean, there's only a certain amount of money that can be allocated to. Not really. Be surprised. What'll end up happening is companies with poor fundamentals that rally will eventually report bad earnings. That capital will be removed from those companies, and those stocks will fall, and that capital will be reallocated to good plays, and those can then again help the rest of the Jenga tower build. So have that faith. Now, I've already reminded you about the coupon code link down below. We did a short extension on that. Sorry about that. I was sick this weekend. I couldn't help with the emails. It's my bad. Like, I think I had like the norovirus or something disgusting. I had like muscle cramps. It was bad. Anyway, so CPI projections for August 10th, which is Lauren's birthday. We're looking for 0.2 on month over month, 0.2 on core, year over year 3.2, which is actually a little bit up from last month at 3%, but that's usually okay because you're just putting in some energy volatility there as oil prices fluctuate, so that's not a big deal. We're more interested in that core number, which is coming in expected to come in year over year at 4.7. So hopefully we can beat that. That would be really cool if we could beat that. And then as far as the Federal Reserve's terminal rate projections, I always like looking at these too. Terminal rate projections, the highest rate the market thinks the Federal Reserve is going to end up getting, right now being priced at 5.38. That's basically where we sit right now. That would be no more hikes right now. So we'll pay attention to that. 5-year break even last week was moving a little bit to the upside, which isn't great because JPOW tends to beat us up when that 5-year break even takes off. Right now, that 5-year break even is flat at about 2.31. We'll pay attention to it. So anyway, this is all really actually fantastic. And Mike Wilson is talking more about his bullishness and talking about how this is Fed pause bullishness. And these are some sectors to pay attention to. Consumer discretionaries with some risk, but financials, no recession, those get interesting again. And the moves you've seen so far could just be the beginning. So it bears some more financial analysis on that, and we'll be doing some more of that. So anyway, thank you so much for watching. We'll see you in the next one. If you liked the video, consider sharing it, and we'll see you soon. Thanks, bye. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by artificial intelligence. If you can master AI by starting on the ground floor, let's go.